Most investors lost everything when the dot-com bubble burst in 2000. From speculators, chasing internet stocks, to disciplined investors holding bonds and dividends, outcomes varied dramatically based on one factor alone: strategy. Nasdaq dropped 78%. Trillions disappeared. Yet some portfolios stayed intact, and a few actually grew. What separated the survivors from the victims? We explore investment strategies that survived this historic crash and protected real wealth. Diversification across asset classes. The dot-com crash created a clear dividing line between two types of investors. Those holding concentrated technology positions lost 80 to 90% of their portfolios. Those with assets spread across multiple categories experienced losses closer to 25%. The 60-40 portfolio split between stocks and bonds declined approximately half as much as the broader stock market. Government bonds delivered returns above 8% annually during 2000, 2001, and 2002. The 10-year Treasury yield fell from 6.5% in May 2000 to 3.8% by September 2002, pushing bond prices higher as stock prices collapsed. International markets followed different trajectories than American equities. European and Asian stocks, while not immune to the downturn, did not carry the same concentration in speculative internet companies. Investors with global exposure avoided the full weight of the Nasdaq's destruction. Real estate investment trusts continued paying distributions throughout the crash. Property values and rental income operated independently from stock market valuations. This asset class provided both returns and stability when equities offered neither. The mathematical advantage of diversification compounds over time. Investors who lost only 25% needed their portfolios to gain 33% to recover. Those who lost 80% needed gains of 400% to return to their starting point. The recovery timeline differed by years, sometimes decades. Commodity exposure, including gold, also provided protection during this period. Gold remained stable while technology stocks collapsed. Prices began rising during the later stages of the crash as investors sought alternatives to equities. Asset allocation decisions made before the crash determined financial outcomes for millions of households. The strategy required no prediction of which stocks would fail or when the bottom would arrive. Staying the course, the Nasdaq fell 78% between March 2000 and October 2002. During this period, many investors sold their holdings at significant losses. This decision had permanent financial consequences. Selling during a market crash converts unrealized losses into realized losses. An investor who purchased technology stocks in 1999 and sold in late 2002 locked in the full decline. Those funds could no longer participate in any future recovery. Investors who maintained their positions experienced a different outcome. The Nasdaq eventually returned to its previous peak, though this recovery took 15 years. Those who remained invested also continued receiving dividend payments throughout the downturn, which provided some return even during the worst periods. The S&P 500 shows a consistent historical pattern. Over every 20 years on record, the index has delivered positive returns. Investors who sold during the dot-com crash and stayed out of the market missed subsequent gains, including the bull run that began in 2003. Research from Vanguard demonstrated that by the end of 2002, approximately 70% of 401k accounts had lost at least 1/5 of their value. Many account holders responded by reducing or stopping their contributions entirely. This reaction compounded their losses by preventing them from purchasing shares at lower prices. The financial cost of panic selling extends beyond the initial loss. Investors who exit during downturns typically wait until markets have substantially recovered before re-entering. This pattern results in selling low and buying high, the opposite of successful investing. It simply required inaction during a period when inaction felt extremely difficult. Dollar cost averaging. Most investors try to time the market. They want to buy at the bottom and sell at the top. During the dot-com crash, this approach failed spectacularly. Nobody knew where the bottom was. The Nasdaq kept falling for over 2 years, and every time someone thought it had hit the floor, it dropped further. But a small group of investors used a completely different method. They invested the same fixed amount of money every single month, regardless of what the market was doing. When prices were high, their money bought fewer shares. When prices collapsed, that same money bought significantly more shares. This approach is called dollar cost averaging, and it turned the crash into an advantage. Consider an investor putting $500 into the market every month, starting in early 2000. In March of that year, when the Nasdaq was at its peak, that money bought a small number of expensive shares. But by late 2001, when prices had fallen dramatically, the same $500 bought 3 or 4 times as many shares. Over the entire crash period, this investor accumulated a massive position at an average price far below what anyone who bought at the peak had paid. When the market eventually recovered, those extra shares purchased at low prices generated substantial returns. The investor didn't need to predict the bottom, simply kept buying through the pain. Emotional discipline required was significant. Continuing to invest while watching previous investments lose value feels counterintuitive. Every instinct screams to stop putting money into something that keeps falling. But those who maintained their regular contributions through 2000, 2001, and 2002 positioned themselves perfectly for the eventual recovery. Dollar cost averaging removes the impossible task of timing the market. It transforms volatility from an enemy into an ally. And during one of the worst crashes in market history, it quietly built wealth for those patient enough to stick with it. Treasury bonds and safe haven assets during the dot-com collapse, capital flowed rapidly out of equities and into government securities. This flight to safety produced significant returns for investors already holding treasury bonds. The U.S. 2-year Treasury yield fell 74% during the crash, dropping from 6.9% in May 2000 to 1.8% by September 2002. The 10-year Treasury yield declined 41% over the same period. Since bond prices move inversely to yields, existing bondholders saw substantial capital appreciation while stock investors absorbed losses. Long-term Treasury bonds gained more than 27% during the worst of the downturn. This performance occurred precisely when stock portfolios needed protection most. Gold demonstrated its traditional safe haven role during this period. While the Nasdaq lost nearly 80% of its value, gold prices remained stable and began appreciating during the later stages of the crash. The metal attracted investors seeking assets uncorrelated with equity markets. Cash and money market funds preserved capital entirely. Investors holding cash maintained full liquidity, allowing them to deploy funds into equities at depressed prices once selling pressure subsided. The common characteristic among these assets was their independence from corporate earnings and technology sector valuations. Government bonds paid interest regardless of whether internet companies generated profits. Gold held value based on factors entirely separate from stock market speculation. Safe haven assets served 2 functions during the crash. They limited overall portfolio losses. They provided stable capital available for redeployment when equity valuations became attractive. Defensive sectors, while technology stocks collapsed, 3 sectors delivered positive returns during the dot-com crash. Consumer staples, healthcare, and utilities outperformed the broader market by wide margins. Consumer staples posted annualized returns of 11.2% between 2000 and 2002. Companies producing household products, food, beverages, and personal care items maintained steady revenues because consumers continued purchasing necessities regardless of economic conditions. Demand for toothpaste, groceries, and cleaning supplies does not fluctuate with stock market valuations. Utilities demonstrated remarkable strength during the crash. Southern Company gained 132% during the entire bear market period, when the S&P 500 fell 49%. Dominion Energy and NextEra Energy also generated positive returns. These companies benefited from regulated business models, predictable cash flows, and essential services that customers cannot eliminate. Healthcare stocks maintain stability because medical spending operates independently from market cycles. People require medications, hospital visits, and medical devices regardless of whether technology stocks are rising or falling. Pharmaceutical companies and medical device manufacturers continued generating profits throughout the downturn. These sectors share specific characteristics that explain their resilience. They produce goods and services with inelastic demand, meaning consumption remains relatively constant despite economic changes. They typically carry lower debt levels than growth companies. They generate consistent cash flows that support dividend payments. Investors allocated to defensive sectors received dividend income while their technology-focused counterparts watched capital evaporate. The combination of capital preservation and ongoing income created substantially better outcomes over the crash period. The lesson from this period is that sector allocation matters as much as overall market exposure. Defensive positioning provided protection that broad market investments could not deliver. Systematic rebalancing investors who followed a disciplined rebalancing schedule sold technology stocks. Throughout 1999, without needing to predict the crash, the process was entirely mechanical, yet it protected substantial wealth. Rebalancing works through simple portfolio maintenance. An investor sets target allocations, perhaps 60% stocks and 40% bonds, then periodically adjusts holdings to maintain those percentages. When one asset class outperforms, it becomes overweight in the portfolio and must be trimmed. The proceeds shift into underperforming assets. During the bubble years, technology stocks surged far beyond their original portfolio allocations. An investor who started 1998 with 20% in tech might have seen that position grow to 40 or 50% by late 1999 simply through price appreciation. Quarterly or annual rebalancing forced automatic sales of those inflated positions. Investors following rebalancing rules took profits from technology stocks at elevated prices and redirected capital into bonds and other asset classes. They did not need to believe a crash was coming. The system required only adherence to predetermined allocation targets. When the crash arrived, rebalanced portfolios held smaller technology positions than portfolios left untouched. The damage was contained because exposure had been systematically reduced during the run-up. Rebalancing also worked in reverse during the downturn. Stock prices fell. Disciplined investors purchased equities to restore target allocations. This buying occurred at progressively lower prices, positioning portfolios for stronger recoveries. The strategy removed emotional decision-making from the investment process. Selling winners feels difficult. Buying falling assets feels dangerous. Rebalancing rules override these instincts and enforce rational portfolio management regardless of market conditions. Dividend-focused strategies, companies paying consistent dividends, separated themselves from speculative investments during the dot-com crash. These businesses had actual profits to distribute, which served as both a quality signal and a source of returns when capital appreciation disappeared. Most dot-com companies paid no dividends because they had no earnings. Their stock prices depended entirely on future growth projections. When confidence collapsed, these stocks had nothing supporting their valuations. Share prices dropped to zero for companies like Pets.com because there was no underlying profitability. Dividend-paying utilities, consumer goods manufacturers, and established industrial firms generated real cash flows. They returned portions of these profits to shareholders through regular payments. During the crash, these distributions continued regardless of stock price movements. The mathematics provided meaningful protection. An investor receiving a 4% annual dividend yield experienced smaller total losses than investors holding non-dividend stocks with equivalent price declines. Over a multi-year bear market, this difference compounded significantly. Reinvested dividends purchased additional shares at depressed prices throughout the crash. Investors who automatically reinvested accumulated more shares during 2001 and 2002 when prices were lowest. These additional shares amplified returns when the market eventually recovered. Dividend stocks also attracted income-focused shareholders who hold positions longer and sell less frequently during downturns. This investor base created price stability that growth stocks lacked. The crash demonstrated that dividends represent more than income. They indicate financial health, management discipline, and sustainable business models. Holding cash reserves, investors holding significant cash positions before the crash possessed a critical advantage, while fully invested portfolios suffered the complete decline. Cash reserves maintained full purchasing power throughout the downturn. The opportunity cost of holding cash reversed dramatically in 2000. During the bubble years, cash earned modest money market returns while stocks climbed 20 or 30% annually. Critics dismissed cash holders as overly cautious. But when the Nasdaq fell 78%, that same cash retained its entire value. Professional investors refer to available capital as dry powder. The term originates from military preparation keeping gunpowder dry until the moment of battle. In financial markets, dry powder means capital ready for deployment when valuations become attractive. By late 2002, investors with cash reserves faced extraordinary opportunities. Quality technology companies traded at 70 or 80% discounts from their peaks. Established businesses with real earnings sold at single-digit price-to-earnings ratios, so investors without cash could only watch. Those with reserves could act. The strategy required accepting underperformance during rising markets. From 1998 to early 2000, cash holders trailed equity investors by enormous margins. Maintaining conviction while others celebrated gains demanded unusual discipline. Liquidity also provided psychological stability during the crash. Investors with cash reserves experienced less pressure to sell existing holdings at depressed prices. They could meet financial obligations without liquidating stocks at the worst possible moment. The dot-com crash demonstrated that cash is not merely a placeholder between investments. During market extremes, liquidity becomes a strategic asset with measurable value. Buying quality stocks after the crash by October 2002, the Nasdaq had fallen 78% from its peak. Headlines predicted further collapse. Investor sentiment reached extreme pessimism. Yet this precise moment offered the greatest buying opportunity in a generation. Contrarian investors recognized that quality companies had become drastically undervalued. Microsoft traded at a fraction of its 2000 price despite maintaining profitability and market dominance. Cisco, Intel, and Oracle businesses with real revenues and established customer bases sold at prices disconnected from their fundamental value. The distinction between quality and speculation became clear only after the crash. Companies like Amazon survived because they possessed genuine business models and paths to profitability. Amazon's stock fell from approximately $100 to $7, yet the company continued operating, expanding product lines, and building infrastructure. Investors who purchased at the bottom captured returns exceeding 10,000% over the following 2 decades. eBay, Priceline, and Salesforce followed similar patterns. Each company declined severely during the crash, but possessed sustainable competitive advantages. Patient buyers who identified these survivors accumulated positions at historically low valuations. The challenge was psychological. Purchasing stocks during a crash requires acting against overwhelming negative sentiment. Every headline suggested further losses. Experts predicted extended downturns. Friends and colleagues had abandoned the market entirely. Successful contrarian investors focused on business fundamentals rather than market sentiment. They asked whether companies would exist in 10 years, whether products solved real problems, and whether management had demonstrated competence. Price became secondary to quality assessment. The best time to buy during the dot-com era was precisely when buying felt most dangerous. Value investing, Warren Buffett became a target of ridicule during the dot-com bubble. From mid-1998 to early 2000, Berkshire Hathaway fell 44% while the Nasdaq soared 145%. Barron's published a cover story asking what was wrong with him. Analysts suggested he had lost his touch. Buffett refused to purchase technology stocks because they violated his fundamental principles. He invested only in businesses he understood, with predictable earnings, strong competitive advantages, and reasonable valuations. Internet companies offered none of these characteristics. Their prices reflected speculation about distant futures rather than current financial performance. His portfolio contained insurance companies, consumer goods manufacturers, and utilities. These businesses generated actual profits. Coca-Cola sold beverages. Geico wrote insurance policies. These companies lacked the excitement of dot-com startups, but possessed something more valuable: earnings. When the bubble burst, everything reversed. Technology stocks collapsed, while Berkshire's holdings maintained stability. The same analysts who questioned Buffett's relevance watched his approach vindicated completely. Value investing did not merely survive the crash, it was proven correct. The core principles Buffett applied remained consistent. Price-to-earnings ratios matter. Cash flow matters. Competitive moats matter. Paying reasonable prices for quality businesses matters. These fundamentals were ignored during the bubble and remembered painfully afterward. Buffett later introduced the ratio comparing total market capitalization to GDP as a valuation indicator. Before the crash, This measure reached approximately 140%, signaling extreme overvaluation. He had recognized the danger, while others chased momentum. The dot-com crash delivered a decisive verdict. Speculation produces temporary gains. Value investing produces lasting wealth. Private equity and illiquid investments. Investors locked into private equity funds experienced an unexpected benefit during the crash. They could panic sell. Private equity investments operate under multi-year lockup periods that prevent withdrawals regardless of market conditions. Investors commit capital up front, and fund managers deploy that money gradually over time into private companies outside the public markets. These holdings don't carry daily market prices. There's no ticker symbol updating every second to watch decline. There's no trading platform with a sell button to press when fear reaches its peak. This structural illiquidity created a barrier between investors and their worst impulses. The same restrictions that might frustrate investors during normal times became protective walls during the crash. Selling required waiting years, not minutes. The option to make a panicked decision at the worst possible moment simply did not exist. This enforced patience prevented the behavioral mistakes that destroyed public equity portfolios during the dot-com collapse. The funds that had invested capital before 2000 often purchased ownership stakes in companies at reasonable valuations during more rational periods. These private companies operated away from the speculation-consuming public markets. Fund managers worked directly with portfolio companies to improve operations, cut unnecessary costs, expand profit margins, and build sustainable businesses. Years later, they exited these investments at profits through sales or public offerings, completing the cycle completely detached from the chaos that consumed public market investors. Major institutional endowments recognized the value of this approach. Yale and Harvard allocated significant portions of their investment portfolios to private equity and other illiquid alternatives during this era. Their chief investment officers understood that lockup periods served a purpose beyond fund manager convenience. These restrictions aligned investor behavior with long-term outcomes rather than short-term emotions. The results spoke clearly. Endowment returns through the crash period outperformed traditional portfolios holding publicly traded stocks and bonds by substantial margins. The inability to sell became the reason for superior performance. The liquidity transformed from apparent weakness into genuine strength when markets turned against conventional investors.